Yeah, I mean, it's a great point. This is one of the things that I think is behind the bid in the gold price is the investors that are buying, and it's overseas central bankers, right?
Right.
Look at the situation and realize, wait a second, the Fed is trapped, right? Inflation is going to remain sticky, remain persistent, likely due to a number of factors, right? Deglobalization, the fiscal situation, demographics are all kind of longer term drivers of inflation that are at work right now.
Hmm.
And the Fed doesn't have the leeway to adequately address it because of the debt situation, such a problem. And so the answer is there could be some type of yield curve control or something, in our future. And, the message is very, clear to, central banks around the world. I don't want to own dollars or treasuries in that world, right?
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. Today, we're fortunate to have with us Jesse Felder. Jesse began his professional career at Bear Stearns and later co-founded a multi-billion-dollar hedge fund firm headquartered in Santa Monica, California. Since founding Felder Investment Research, which is the publisher of the Felder Report, his writing and research has been featured in major publications and websites like the Wall Street Journal, Barron's, Yahoo Finance, Business Insider, Investing.com, and so much more. Jesse, thank you so much for joining us today.
Yeah, good to be with you, Gary.
So let's begin with the most recent situation in the presidential race and how it affects the economy and markets. Does the attempt on former President Trump's life at his rally the other day fundamentally change your view on the economy and markets? And if so, in what ways?
It doesn't change my view much at all. I think one of the biggest factors that I'm looking at going forward is this willingness or lack of willingness to address the issue in the growth of the federal debt. And it seems like it's kind of a bipartisan decision to completely ignore it, pretend there is no issue. So, to my way of thinking, it doesn't really matter who wins the presidency if neither party is going to address it. Then it's going to continue on this trajectory that could eventually become a problem. When somebody like Bill Dudley, who's the former head of the New York Fed, has been warning basically all year about the risks of a debt spiral, I pay attention to that, and I think that's a real risk. And so long as neither party is willing to even address it, it's going to continue to be out there.
So, the fiscal dominance, the massive deficits, non-wartime, non-recessionary deficits. Do you see a Trump campaign administration continuing those, or do you think they would try to actually balance the budget and maybe suffer the consequences for a period of time economically?
No, I think that the pain, I mean, this is why neither party wants to address it, is the pain associated with doing that is just too great to contemplate at this point. I think if you look at the economy has avoided recession because of the, extra, I guess, fiscal profligacy in terms of, between the tax cuts that Trump put into effect back in 2016, and then all the COVID spending, and then basically the industrial policy we've seen since Biden took office. It's all kind of worked to support the economy in a significant way. Obviously, we've seen it manifest in a huge boom in inflation as well. So I think that if you were going to address it at all, it's going to have major economic consequences that are just, I think, too difficult to consider at this point.
And so therefore, no matter who wins, you don't see either of them tackling that.
The problem is, if you're the guy who's going to tackle it, your party's going to have a really difficult time getting elected for a very long time afterwards, which is why there's a bipartisan consensus here to not address it, because nobody wants to be the guy, the party, whatever, to actually address the issue, because it absolutely has to involve cutting Social Security, Medicare spending in some way, and that's a political non-starter because you lose millions of votes right there. But it also probably involves at least freezing military spending and raising taxes. And those are all issues that are very difficult to run a campaign on. And
Right.
so, if you do any of that stuff, it's the right thing to do in terms of for the fiscal trajectory of the nation. But it's any political strategist would tell you it's suicide.
So it sounds to me then that it's just the timing of the Big Bang when the debt issue becomes the real, problem. That's what I'm terming the Big Bang. It's just a matter of when is that going to occur at this point.
Yeah, and I've been watching I've been saying for about a year now that 10-year the chart of the 10-year Treasury yield is the most important chart in the world, because if we're going to get, I think it's going to manifest there, that at some point, whatever you want to call them, the bond vigilantes are going to come back. You're going to see rates go up. I think that one of the things that I've been worried about is if you go into recession, and it threatens obviously to blow out the deficit even further, you could see, instead of rates coming down in a recession, like everyone's kind of been conditioned to expect by
Right.
history, you could actually see rates go up in a recession as an effect of, oh, wow, the deficit's blowing out even further. There's going to be the already, rapidly increasing supply of issuance is going to go up, by in a significant way. And there's just not the demand there to meet it. So, I think if you were to, we're already seeing a slowing economy. Long end is not really responding. Short end is, which is why we're seeing a kind of a narrowing in the yield curve, an ending of that inversions, at least on the 2 to 30 year spread. I think if you were to see that kind of continue, where 2-year comes down and 30-year goes up, that's a sign that the bond market vigilantes are worried about the impacts on the debt supply by created by recession.
So, Jesse, the following is a headline on a prominent business news site that I found. Investors bet a Fed rate cut to spur rotation from crowded stocks to neglected stocks. Are you in the camp that sees a rotation out of growth and into value, the neglected, if you will, areas such as energy, metals, miners, et cetera? Do you see a rotation coming? And if so, what does that rotation look like to you?
I do. It's very much, to me, reminiscent of what we saw in the early 2000s, where, back in 1999, 2000, I was head trader at a hedge fund, and nobody wanted anything to do with so-called old economy stocks, right? If they were bricks and mortar, retailers, they were oil and gas companies. They were literally all left for dead.
Mm-hmm.
Precious metals, mining companies. Nobody wanted to touch them with a 10-foot pole. Everybody wanted to chase the red hats, the Netscapes, the hot stocks of the day. But after that March of 2000 blow off, immediately there was a rotation into stocks like, I owned stocks like Abercrombie and Fitch at the time, which were trading 5, 6, 7 times earnings for a pretty hot retailer at the time. Washington Mutual was a thrift back then, which is a very, kind of safe banking institution, trading at 5 times earnings. And it was a great time to be a value investor. It worked really well for a number of years after that. And I do see parallels to this point in time. I guess the big difference I see is there isn't like a huge section of the market that's really cheap today. Generally, the whole market is, I think, overvalued, with the exception that I do think there's still really good value in things like energy stocks and in precious metals. I think, you just look at what Warren Buffett's been doing for the last year, right? He's the biggest buyer of T-bills in the world. He's not buying any long-term debt, selling down the Apple stake. What's the only stock that he's buying? Occidental Petroleum, right? Give me hard assets and give me T-bills, because of the optionality for when things, go wrong. I'm going to have some cash to put to work. But I think the writing is on the wall in terms of the direction of inflation. We've had a nice period of disinflation that has allowed a lot of these tech stocks to really dominate. If we start to see a rotation in the trend in inflation, which I think is possible, then that would benefit. We'd go back to, people saying, I need to own hard assets again to protect myself because the Fed didn't do enough to really sustainably bring inflation back down. And they're not going to do enough.
I don't want to put words in your mouth, but it sounds like if you were asked to bet, you would bet on that versus this current trend continuing.
Absolutely. One of the indicators I watch most closely, and this dates back to my hedge fund days. We tracked insider trading very closely. What are the top executives doing at across corporate America with their own shares? And when you see them in aggregate buying heavily, it's a very bullish sign for not just stock market returns, but also the economy over the next 12 to 24 months. And right now, we're right about at the highest level of insider sales to buys that we've seen in at least a decade. The only time that comes close was that late 2021 time period where you saw, Amazon, last time Jeff Bezos was offloading stock in the way that he is today. So you have Jeff Bezos, Michael Dell, Jensen Huang at NVIDIA. All these guys are selling stock in a way they haven't done for several years. And it's the least amount of insider buying in the major stock market, areas of the stock market since at least 2012. Like, insiders have zero interest in buying shares today, and they're selling at like they've rarely done. So to me, that tells me we're very close to a top in terms of performance of the leading sectors, the technology, communication services, probably close to a top in terms of this earnings rebound and economic activity, and things could potentially roll over over the next 12 to 24 months in terms of the economy and earnings growth.
Mm. In your analysis, what's the biggest risk that the Fed faces right now?
Well, I mean, I think there's risks on both sides of the mandate. It's very clear that the economy is slowing and the consumer is struggling, right? I mean, we had a number of companies come out early in this earnings season already saying that the consumer is struggling, and they're seeing less traffic in stores. They're seeing, especially in consumer discretionary areas, consumers are really cutting back. So, and then you see, sustained, continuing jobless claims are showing it's tough to get a job in this market. So, unemployment's ticking up. But at the same time, I think a lot of the tailwinds to disinflation may be behind us. We're starting to see the costs of transporting goods around the world are going up. I mean, we've regained more than half of the decline in shipping costs, just over the last few months with what's gone on in around the world in terms of geopolitical upheaval. And I think there's there is a risk to the inflation side of things, where I think maybe most of the trends in goods inflation is done. And if goods inflation starts to pick up again, it's going to be a real difficult thing for the Fed to deal with. Still sticky inflation, if not a resurgence in inflation, at the same time as the economy weakens and unemployment rises. And I think the thing to kind of glean from that is if that's the case, if inflation's not going to come back sustainably to target and the economy is going to continue to slow, the Fed can maybe pull off a couple of rate cuts, but they're not going anywhere near zero again. They just can't. They can't afford to do that with inflation, the inflation dynamics being so different than they were over the previous decade.
And that puts the debt situation, the debt servicing situation, in the right square in our face as a major problem. The debt is so large that if they keep the interest rates elevated to any level, the debt servicing stays really high.
Yeah, it's a great point. This is one of the things that I think is behind the bid in the gold price, is the investors that are buying, and it's overseas central bankers, right? Look at the situation and realize, wait a second, the Fed is trapped, right? Inflation is going to remain sticky, remain persistent, likely due to a number of factors, right? Deglobalization, the fiscal situation, demographics are all kind of longer term drivers of inflation that are at work right now. Mm-hmm. And the Fed doesn't have the leeway to adequately address it because of the debt situation, such a problem. And so the answer is there could be some type of yield curve control or something, in our future. And, the message is very, clear to, central banks around the world. I don't want to own dollars or treasuries in that world, right? I want to own something that will protect me against a dollar debasement.
And no counterparty risk, right?
Right. Exactly.
So I do have questions on inflation, but before I get to that, you mentioned the consumer. I do have a question there. So Jesse, let's discuss the Michigan Consumer Sentiment Report. It's still falling sharply. In your analysis, how would you describe in detail the strength of the consumer and what probably happens next for them?
Well, I mean, there's is my friend Peter Atwater. I think was really the guy who coined the phrase "the K-shaped economy." Right? You have the people on the top of the K that are very wealthy and they're doing great and they own stocks and they own real estate and they have money in the bank that's earning 5%, and they're doing very well. And the people on the bottom half of the K don't own stocks, they don't own real estate, and they don't own, they don't have cash, earning, generating interest in accounts. And the people in the bottom half of the K are struggling. I think during the pandemic, a lot of the money that was pumped into their bank accounts directly, really kind of alleviated that situation for a time and created the boom that we saw for a couple of years. But I think now that has, well in the rear view mirror, that bottom half of the K is really starting to struggle. And that's what, a lot of the banks who reported earnings last week were saying, is that we're seeing that, those folks are really starting to have issues. Now, you're also even starting to see it. I think it was, maybe Pepsi, Frito-Lay was saying that even people in a higher income levels it's starting to creep up to those people as well, and we're starting to see it some weakening kind of across the board. There was another restaurant company, I can't remember the name right now. It's kind of said the same thing, that we're just seeing less traffic, and it's across income levels. So that would be kind of a new change in trend that we're seeing over the last few weeks, maybe month or two, where the more higher end consumer is starting to slow down as well. But I think it's been very clear for months now that the bottom end of the K has really been struggling with higher inflation, higher costs, and then a slowing labor market.
With the savings being as low as it is, and with the credit card debt being as high as it is, in addition to all the other debt that the consumers have taken out, and now this multi-year inflation pressure that they've been experiencing, are you anticipating a rise in foreclosures, bankruptcies, that type of thing coming in the near future?
I mean, that's typically what we see in a recession, and I do think we are headed for a recession if we're not already in one, right? I mean, the only reason the SOM rule wasn't triggered over this last jobs report is the trailing 6 month or 12-month average or whatever is starting to tick up too. So the hurdle rate is getting higher for it to trigger recession. So I think there's just a ton of signs. One of the things that I watch, Stan Druckenmiller has said, the best economist he's ever seen is the inside of the stock market. What are those economically sensitive sectors in the stock market doing relative to the broad market? So what are retail stocks doing? And we've seen Nike get hammered. Walgreens has gotten hammered over the last, several months. What are the home builder stocks doing? Home builder stocks have started to underperform. But materials and small caps and these types of things have been dramatic underperformers this year. You also have a Dow theory, sell signal where the industrials make a new high, transports fail to confirm. So you have a lot of messages from the inside of the stock market suggesting that it's time to pay close attention to the trend in the underlying economy. I do think it's to the point now where it's suggesting recession is a very real risk, and that would suggest that bankruptcies and things are headed higher. I think we did just see too that corporate bankruptcies hit the highest level since 2020. And so that's another good indicator that things are trending in that direction.
I think it actually exceeded 2020 and was the highest since 2010. Since the GFC.
Right.
But investors are selling out of the riskiest U.S. junk bonds in favor of high quality debt. And that's amid the surge you're just talking about of the corporate America bankruptcies. Can the weakest corners of corporate America survive all of this? And how much longer can they? And what does your analysis point to if they can't? How much of a jump in unemployment could we possibly expect through this part of the cycle?
Well, this is where we start getting into, black swans, right? I mean, there are things that we know about. There's the regional banking issues with, commercial real estate, and I think
Yeah.
that's a huge overhang, and people are well aware of that. But I think what people are maybe, none of us are really aware of to any extent or any measurable way is the consequences of 0% interest rates for a decade, right? Is the consequence of that is everybody, corp CFOs to investors to everybody, comes to believe that interest rates are going to stay zero for forever, right? And so once you make that assumption, then you start making business decisions and all these things based on the idea that interest rates are never going to go up again. We saw Bloomberg cover article, the Economist cover articles, inflation is dead, it's never coming back in 2020, 2019. And so now we have this situation where it looks like 0% is never coming back, right? We have these supports to inflation. I call them secular trends that are going to sustain inflationary pressures going forward. I mentioned a few of those: deglobalization, demographics, where you have a shrinking workforce relative to the overall population, putting more pressure on fewer workers, supports wages and inflation. And this industrial policy of we really need to invest in producing things here, even though it's way more expensive to do. So there's just a number of these things, and so the longer we go, and the more people have to recognize we're not going back to zero, the more we're going to learn about, I think, these decisions that were made based on the assumption that interest rates were going to stay low forever. We saw it, like it was a surprise with the regional banks. All those regional banks who went and leveraged up long-term bonds at, I'm going to buy billions, billions of dollars worth of 10-year treasuries at under 1% yield. And, you only do that if you think yields are never going to go up ever again. And then they do go up, and then there's a problem. And I think that you make a good point in looking to these corporate balance sheets, because I think a lot of these companies have been hanging on. They're using payment in kind loans and things like this to try and put off the eventual reckoning. But the longer we go without interest rates actually coming back down to zero and allowing for that easy refinancing, the more we're going to see these problems creep up. And I think you're right to look at the corporate debt market as one of those potential areas.
So the longer we go, the higher the probability of a pretty good rise in unemployment, because the malinvestment, the misinvestment that's taken place with the lower interest rates is going to have to get rectified at that part of the cycle.
And I think, we're seeing it right now in real time. I think with the generative AI mania right now, right? I mean, we're seeing literally tens, if not hundreds of billions of dollars invested in this stuff. And, 50, 60, $70,000 NVIDIA chips, and companies buying thousands of them. And it's really a FOMO trade on the part of big tech to invest so massively in these things. It's one of the things that's really boosted the economy, created a wealth effect through the stock market and all of these things. But there's literally no sign of these investments paying off anytime soon, right? I don't know anybody who's paying for a chatbot right now. I use them. I like Perplexity is one that I use and I like, but I would never pay to use it. The payoff has to be massive based on the capex they're putting in right now. To me, it's another similarity to what we saw back in 99, 2000, was building out the backbone of the internet. Cisco sold 1 million routers. They laid fiber optic cables across the Atlantic Ocean. And, there was the overinvestment really benefited us, over time, but all the companies that went through it, the mass amount of them went bust. And Alan Greenspan was so afraid that bust was going to create another Great Depression. He lowered interest rates to 1%, created a housing bubble. I don't think Jay Powell's going to be able to do that this time, but I do think that the unwinding of this AI mania, the backside of this capex spending boom could be have a pretty painful economic downside when it comes to an end.
Yeah. Yeah, I could see that too. So let's go back to the inflation that you were talking about earlier. Today's inflation path seems to be tracking the inflation path of the 70s with a high correlation. If the correlation holds, and that's an if, that means that soon, 6 months or so, we can expect another significant rise in inflation, this time pushing higher than the 9.9% that was experienced back in 22, 23. Are you expecting this correlation to hold and a surge of inflation to hit later this year and into 2025? Or are you more on a let's just wait and see approach kind of a thing?
I would not be surprised to see it hold for a number of reasons. The echo is very, very similar to, that 70s time period where, actually, we should point out that the Fed actually raised rates significantly more in the early 1970s than Jay Powell did, right? They actually took, created a real Fed funds rate in positive, to the positive side of the ledger, whereas, Jay Powell has kept the Fed funds rate below the rate of nominal GDP growth, I think longer than anything we've ever seen, right? That was not what they did in the 70s, and they actually raised it above nominal GDP growth. So I think that, there's a case to be made that they didn't necessarily do enough. And then also, if you believe that they're going to start cutting rates because of the disinflation that we've seen, it's not hard, I think, to argue that, they're taking a false sense of confidence in this, basically just the trend in goods inflation, right? We've seen a collapse in goods prices because consumers went from being locked down and spending on goods to, okay, now we're free. Now we want to go spend on services. And the spending on goods kind of evaporated, and that really helped the disinflationary trend. But I think it's hard to get much more disinflation from the goods side of things. And like I said before, with the transportation costs really soaring again, I think it's, and a lot of the production of goods being reshored here, I think the writing is on the wall that the trend in goods inflation is probably going to turn higher at some point, possibly very soon. The other side of the inflation trend is the comparisons for the rest of the year start to get really difficult, right? We had a nice disinflationary trend at the end of last year. So those year over year comparisons are going to start to become problematic, that I think even if we get pretty good inflation numbers for the rest of the year over year trend is going to start climbing again, just based on those comparisons. And so I think that there's a risk if they really start to ease now into some of these issues we're talking about, that it could start to reaccelerate again.
So not a lot of relief in sight for the consumer.
Yeah.
So
and the other side of it is too. I mean, we've created, we do have a housing shortage, in this country, especially when we have, millions of immigrants coming into the country, exacerbating the housing shortage. But the raising of interest rates tells, all these builders of multifamily housing and single family housing, stop building, right? It's too expensive. People can't afford to buy them. So we're going to stop building. We're seeing that in housing in permits and all these kinds of things. And so that's only going to make this housing shortage worse going forward. So you combine, shortage of housing and a slowdown in supply of new construction and things with this continued, growth in demand from millennials wanting to, millennials and Gen Y. My kids are Gen Y, and they, want to get apartments and want to start, buying a house and these types of things. And so you have this growing demand at the same time as, they're really stopping the construction of new supply, and it's going to only create bottlenecks further down the road where, it's going to support rent inflation and these types of things for a period of time that, could also. So people are looking at, okay, we get goods deflation, goods disinflation, and the housing side of the inflation numbers are starting to come down. But if you look out into the future, right, like 6 months, a year from now, Unless you get a really, significantly deep recession, I think it's going to be difficult to see a continuation in the downtrend in inflation.
Okay, yeah. So inflation is looking to be sticky to rising to possibly highly correlated to the 70s to a strong takeoff. So, Jesse, some reports have AI data centers using as much energy by 2030 that they would be the equivalent to the ninth largest energy user by country on Earth. Add in the electrification of everything and everywhere, and the rising up of 120 million citizens in the Asian circle from poverty into the consumer class over the next 3 years. And there's going to be a massive energy need in the years ahead, with a sustaining capital investment shortfall of more than $1 billion a day or $365 billion a year for the last decade. How do you expect the energy needs to be met in, oil, natural gas, nuclear, et cetera? And what do you see happening with energy prices on the whole?
Well, I think that this is how you get a commodity supercycle, right? How do you get a commodity supercycle? You get a massive mismatch between supply and demand, right? Everybody thinks that demand is going to, we're going to see peak demand, right? That's why the oil price went negative, part of it in 2020. Because everybody thought, oh, okay, we're not going to need fossil fuels and, anymore, and that we've seen peak, peak oil demand. We literally just in the last few weeks hitting new record highs in terms of demand for oil and gas. And so I don't think that that's going to change anytime soon. My friends at Gehring and Rosenzweig pointed out, we get more and more efficient with our use of a lot of these things, which is a great thing, right, in terms of electricity. But what ends up happening is because we're more efficient, we can afford to use more. So people just use more, and the demand goes up to make up the difference. And so I think you're absolutely right. We're seeing demand for everything just go through the roof, and the AI investment is so massive right now, and it's putting strains on the electricity production. You're seeing a lot of these energy companies say, hey, look, we had plans to mothball these coal power plants here in the United States, that we were going to shut them down this year or next. And now we can't afford to because electricity demand is going gangbusters. And so we have to. So what's going on is, Microsoft, Amazon, they're all committing to buying all this green energy, right?
Yeah.
But then that just means that, us normal consumers, we don't get any access to that green energy. So we have to end up using the coal energy, or the power companies end up having to provide us with the coal power because, the AI companies want to pretend that they're being green. But, both Microsoft and Alphabet have come out and said, they're trending in the wrong direction. They've basically committed to, being zero carbon, zero footprint by 2030. And now they're, trending the other direction. They're going to fail at those goals. And so I think that the writing is on the wall in terms of a lot of this is just demand is going through the roof and is going to continue to, especially with the reindustrialization, remilitarization, a lot of these trends that, we have to build things up. Semiconductor production here in the United States. I mean, we have to do all these things for national security, and it's just going to create more and more demand. And so you're absolutely right. Without any investment in supplies, that's how you get a commodity supercycle. One of my favorite things to look at in terms of for long-term view of things is where is capital going? Follow the capital cycle. Right? When a bunch of capital is invested into a sector of the economy, it usually creates oversupply and a crash in prices there. Crash in prices leads to a dramatic underinvestment in that area, which means there's a dramatic drying up of supplies, which supports prices and creates a boom. And so you saw that from 2008 to 2012, 13, that the super low interest rates created a huge investment into fracking in oil and gas in the United States, over investment in production. You get the oil price crash in 2014, and eventually oil price goes negative in 2020. since that 2014 time period of the last decade, we've seen no investment
Right.
in the supplies of commodities and things, because investors just haven't wanted to. Where's the capital been going? Everyone's throwing money at for a while it was the unicorns and startups, and now it's big tech, and everybody wants to throw money at Nvidia chips and all this kind of stuff. And all that tells you is the returns in those areas is going to be a massive oversupply of AI and all this kind of stuff, in terms of the hardware and data centers. It's going to we're going to see a crash in returns. I mean, that's just how the capital cycle works. And the dramatic underinvestment in the production of commodities and energy and these types of things is going to sustain a bull market in that area for a long time to come.
Yeah, so it sounds like you are in the camp of a commodity super cycle, and you're pro all forms of energy. I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, the economy, markets, artificial intelligence, individual metals and miners, and every single expert interview that we conduct, just like this one. And when you subscribe, we want to give you a free gift. It's a report that we wrote based on an important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us. Also, I'm positive you've enjoyed the conversation with Jesse as much as I have. Please let him know by hitting the like and subscribe button and leaving a comment below the video.